The subsidy. Nobody knew existed for decades. The global economy has operated under an invisible support beam. You never voted for it, you were never told about it, and yet it shaped almost everything in your financial life. Your mortgage rate, your stock market returns, your government's ability to borrow endlessly. All of it rested on one quiet assumption. Japan would keep paying the bill. But that assumption just broke, without fanfare, without headlines, without a warning. Japan has begun pulling back from a financial commitment worth $3.3 trillion, and that single decision is now sending shockwaves through bond markets, currencies, and government balance sheets worldwide. This is not a short-term market event. This is not speculation. This is a structural shift. And today, we're going to explain exactly what Japan was doing behind the scenes, why it can no longer continue, how this changes the cost of money everywhere, and why this may mark the beginning of the end of dollar dominance as we know it. This video is for educational purposes only. Nothing here is financial advice. Let's start with the system most people never learned about. Section 1. The global free money engine. For nearly 30 years, Japan played a role few countries in history have ever played. It became the world's primary source of cheap capital. While other nations raised and lowered interest rates, Japan kept theirs pinned near zero, sometimes below zero. That decision created a global opportunity. Borrow yen at almost no cost, converted into dollars. Invest in higher yielding assets elsewhere. This strategy became known as the yen carry trade, but calling it a trade understates what it became. It evolved into the structural backbone of global liquidity. Banks used it, hedge funds used it, corporations used it, governments benefited from it. Japan exported savings. The rest of the world imported stability, and the scale grew beyond comprehension. Section 2. Why $3.3 trillion matters. Over time, Japan accumulated more than $3.3 trillion in foreign assets, much of it tied directly or indirectly to US financial markets. This capital did something critical. It suppressed interest rates globally. When Japan bought foreign bonds, especially US Treasuries, it pushed bond prices higher, forced yields lower, reduced borrowing costs for governments and consumers. That meant cheaper mortgages, cheaper corporate debt, higher asset prices, larger government deficits without immediate pain. This wasn't charity. It was a consequence of Japan's own stagnation. With limited domestic growth opportunities, Japanese capital had to go somewhere, so it went abroad. And for decades it worked, until it didn't. Section 3. The moment the system cracked. Every financial structure has a breaking point. For Japan, that point arrived quietly in the bond market. Japanese government bond yields, long suppressed by aggressive central bank intervention, began rising. At first, the moves looked insignificant, but in highly leveraged systems, small numbers carry massive consequences. When long-term Japanese yields pushed above levels the Bank of Japan had spent years defending, the message was clear. The market was regaining control. Yield curve control, the policy that allowed Japan to promise infinite bond purchases, started losing credibility. And once that credibility erodes, everything built on it starts to unwind. Section 4. Why rising Japanese yields change everything. Here's the key issue. The carry trade only works when borrowing costs in Japan remain far below returns elsewhere. As Japanese yields rise, borrowing yen becomes more expensive. Currency risk increases leverage positions, become unstable. At that point, investors are forced to reverse the trade. They sell foreign assets, they buy back yen, they repatriate capital. This is the unwind. And unwinds don't happen gently. They happen when risk suddenly matters again. Section 5. Japan's debt trap. Japan isn't just dealing with market pressure, it's dealing with math. Japan's government debt exceeds 250% of GDP, the highest ratio in the developed world. That level of debt only functions when interest rates are extremely low. Every incremental rise in yields increases annual interest costs, crowds out public spending forces, additional borrowing. This creates a feedback loop. Higher rates, higher deficits, more bond issuance, more issuance, higher rates. It's not a theory, it's arithmetic, and the market is starting to enforce it. Section 6. Why stimulus made things worse. Faced with slowing growth and rising costs, Japanese policymakers turned to a familiar tool, stimulus. Large spending packages were announced to support households and businesses. But instead of calming markets, these announcements raised alarm. Why? Because investors no longer see stimulus as growth. They see it as additional debt issuance. In a system already strained by rising yields, more borrowing accelerates the problem. The bond market reacted accordingly. Selling increased yields rose further. Confidence declined. This marked a shift from trust to skepticism. And once that line is crossed, it's very difficult to go back. Section 7, how this hits the United States. For decades, Japan was one of the most reliable buyers of U.S. government debt. That support helped keep Treasury yields, low mortgage rates, affordable federal borrowing costs manageable. Now that support is fading. As Japanese institutions repatriate capital, demand for U.S. Treasuries weakens, yields rise to attract new buyers, borrowing becomes more expensive. This explains a paradox many people are noticing. The Federal Reserve cuts short-term rates, but long-term rates stay high. That's because the issue isn't policy alone. It's foreign demand disappearing. Section 8, the end of the risk-free assumption. For 40 years, global finance rested on a single belief. Government bonds are risk-free. That belief supported pension models, retirement portfolios, the 60-40 allocation strategy. But that assumption only holds when yields are stable, buyers are plentiful, inflation is contained, Japan's withdrawal challenges all three. When bonds fall and stocks fall together, diversification fails. And when that happens, the entire portfolio framework has to be reconsidered. This isn't a temporary anomaly. It's a regime change. Section 9, the currency consequences, expanded. As Japan fights to stabilize its bond market, the stress doesn't stay contained. It leaks into the currency. When confidence in a country's debt begins to wobble, the first place the pressure shows up is foreign exchange. And that's exactly what we're seeing with the yen. A weakening yen isn't just a chart movement. It has real-world consequences that hit households, businesses, and governments simultaneously. Here's what a falling currency actually does. First, import costs. Explode Japan imports most of its energy, food, and raw materials. When the yen weakens, every barrel of oil, every shipment of grain, every industrial input becomes more expensive overnight. Those costs don't disappear. They move straight through the supply chain. Second, domestic inflation accelerates. Higher import prices translate directly into higher consumer prices. Even if domestic demand is weak, inflation can rise purely through currency devaluation. This is the most dangerous kind of inflation, the kind driven by currency weakness, not economic growth. Third, real wages collapse. When prices rise faster than wages, purchasing power erodes. Households feel poor even if their income doesn't change. This creates political pressure, social strain, and declining living standards, all while the government's policy options shrink. And this is where policymakers become trapped, because they face an impossible choice. Raise interest rates and debt servicing costs surge, threatening the government's own solvency. Keep rates low and inflation worsens, destroying the currency and public trust. There is no painless path forward. Every option carries consequences. Every decision shifts pain from one group to another. And this isn't a Japan problem. This is the mathematical reality facing every nation burdened by excessive debt. Japan just happens to be the first major economy where the pressure is becoming impossible to hide. Section 10, why this threatens dollar hegemony, expanded. For decades, the US dollar has occupied a unique position in the global system, not because it's perfect, but because it's been trusted. Dollar dominance rests on confidence, and confidence rests on a few core assumptions. That US debt will always find willing buyers, that treasury markets will remain deep and liquid, that global trade will continue to settle primarily in dollars. As long as those assumptions hold, the system functions. But when a major creditor like Japan begins pulling back, even gradually, those assumptions start to weaken. Not all at once, not dramatically, but enough for other nations to notice. And when they notice, they don't panic, they adapt. Governments and central banks around the world begin asking quiet questions. Should we hold this much exposure to one currency? What happens if liquidity dries up? What if borrowing costs stay elevated for years? The response isn't ideological, it's practical. Reserve managers don't make decisions based on headlines, they make them based on risk. So what do? They diversify. They reduce marginal dollar exposure. They look for assets that don't rely on another government's promise. They seek stores of value that function outside the debt system. This doesn't mean the dollar disappears tomorrow. It means its privileged position slowly erodes. And once confidence begins to fragment, it rarely reassembles in the same way. Section 11, what central banks are doing quietly, expanded. Publicly, central banks speak the language of stability. They reassure, they downplay, they emphasize control. But privately, in their balance sheets and reserve decisions, their actions tell a different story. One trend stands out above all others: gold accumulation. Over the past several years, central banks have purchased gold at the fastest pace in modern history. This isn't coincidence, and it's not nostalgia. Gold is being accumulated for one reason: it has no counterparty risk. Gold doesn't depend on a government's ability to tax, a central bank's credibility, a bond issuer's solvency, or a financial system's stability, in an environment where bonds rely on continued confidence. Currencies rely on fiscal discipline, financial promises are stretched to their limits, assets without liability regain importance. This shift isn't loud, it isn't dramatic, it's methodical. Central banks aren't preparing for collapse, they're preparing for uncertainty, and uncertainty changes how risk is managed. Section 12. The shift from paper to physical expanded. As liquidity tightens and volatility increases, a subtle transformation begins inside the financial system. At first, it's almost invisible. Paper assets still trade, markets still function, prices still move, but priorities shift. Paper claims, promises, contracts, derivatives start to lose their unquestioned status. Physical ownership, assets that exist outside balance sheets, begins to command a premium. This transition doesn't happen in a straight line. It happens in phases. First, confidence weakens, then volatility rises, then liquidity thins, then trust becomes selective, and finally, the system reprices risk. History shows this pattern repeatedly. When debt-based systems approach their limits, wealth doesn't evaporate, it moves. It moves from leverage to safety, from abstraction to tangibility, from promises to possession, from those who react late to those who prepared early. This isn't about fear. It's about alignment with reality. Systems built on confidence eventually test that confidence. And when they do, capital flows toward what doesn't require belief. What we're witnessing now isn't an ending, it's a transition. Quiet at first, then unmistakable. And by the time it becomes obvious to everyone, the shift is already complete. Conclusion. The signal most people will miss. Japan didn't announce a collapse. It didn't ring a bell. It simply started protecting itself. And that decision is now forcing the global system to adjust to reality. The $3.3 trillion plug wasn't pulled in anger. It was pulled out of necessity. And necessity doesn't negotiate. This isn't about panic. It's about awareness. The era of effortless borrowing is ending. The era of suppressed risk is fading. And the consequences will unfold slowly, then all at once. The question isn't whether change is coming. It's whether you recognize the signal early, or only after it's impossible to ignore. Let me know in the comments. Do you think central banks can regain control? Or has the math already taken over? History will record where each of us stood.